Howdy, Jacob here. Today we're looking at AT&T. And I can already see great free cash flow, good looking dividend. Let's get to some financials. $117 billion market cap with a $236.5 billion enterprise value. Wow. Okay, so over double enterprise value is debt. I've seen that before, but I don't think I've ever seen it on a company that market cap is greater than 100 billion. Astronomical return on invested capital, low single digits or negative because they have negative earnings. Margins went from 60.2% down to 57.9 in 2022, but we are seeing an increase, pretty large increase since 2017. That's good there. Operating margin from 23.9 down to 19, but again, up from 14.3% from 6 years ago. So interesting business. It looks relatively flat on the revenue side from 128 in 2013 to 121 billion in 2022. The dividend yield, I think, was already cut, and it was definitely cut, I think, already, and it's still a 6.7% dividend yield. So crazy big yield. Can they afford that? Let's look. Payout about $8.1 billion in aggregate. And I would say a 5-year average of 20 billion. Okay. Yeah, let's say roughly 20 billion, low 20 billion. So that payout ratio is less than 50%. From that perspective, looks absolutely fantastic. I can already see though this debt is going to be troublesome to try to figure out because our free cash flow calculator and earnings calculator doesn't necessarily take into consideration debt. And so we have to take it into consideration on a judgment call. And we can see that they had 66 billion in debt in 2012 and have almost double that in 2022. Now the good news is they got as high as 166 billion in 2018 and have dropped it down to 128 billion. But again, that they have 7.6 short term, 18.7 in capital leases, only 3.7 in cash and cash equivalents. I mean, it's just interesting as like a lender perspective. I just don't understand. Like, yeah, do they produce cash flow like absolute hounds? 1,000%. We're seeing over $20 billion on a 5-year average, but you're so in debt. Even on over $20 billion, that's over 6 times. And again, it's $20 billion. So there's times where percentages make sense and everything, but you make $20 billion and you got 128 billion long-term debt. It's just crazy to me. But to me, I mean, if the lenders are fine with that ratio and the cash on hand, that's great to see. But from a capital allocation standpoint, it looks like they are using a lot of free cash flow, at least 2022, 2021, over half or about half, to make acquisitions. When again, that's going to say that they have growth and everything, which for what's AT&T called the dinosaur company, growth seems fantastic and everything. But to me, I mean, if the shares get stupid cheap, I want you to buy back stock. But otherwise, a dividend and then everything else, all remaining use of cash flow to pay down this debt. I mean, 6 times is not super crazy, but it can be if you don't allocate money towards it. Because you got to think if you have the current dividend yield pays out maybe 45% of their free cash flow. If you're only, and you use 30% on acquisition and 5% share buybacks, you only have 20% use to pay down debt. And it looks like they're not even doing that. It looks like, maybe they did in 2022, maybe they did in 2019, 2020, but then entirely offset it in 2021. And so I want this business to consistently, if there's opportunities that make sense for the business where their capital allocation could make fantastic returns, it makes sense to make that acquisition, which most of them are usually just revenue increases and not actual cash flow increases. But, to each their own. I will say that I'm ready to make assumptions here. I think revenue side, man, this might be just flat Stanley here. I'm just going to assume that they don't really grow. And I mean, yeah, say moat all you want because it's essentially an oligopoly between T-Mobile, Verizon, and AT&T in the phone business and the wireless communication business. But the debt situation is just astounding to me, and I can't. I need to be conservative with some of these assumptions here, and so. I mean, let's see what a 2% bump would actually do to them. So 128, let's say 130 billion dollars, 2%. You're looking at 26. Whoa, what is that? 13, 1.3, $2.6 billion. 2.6 billion and the 5-year average of 20 billion. You're looking at about 20%, 15 to 20%, or 10 to 20% hit on the margins there. Again, they produce so much cash flow, but if they keep this dividend the same and they get hit 15% on their margins, then it's just not going to be great for them, and they're really going to have to use some of that capital allocation, to go towards paying down debt. Um, I think on the margin side, maybe what I see 8 and 14. Let's say 8 and 10. Maybe there'll be or 7 and 10. Some sort of convergence on the margin side. Share change relatively flat. I'll say flat. I mean, it's tough because we're saying with these assumptions it needs to fall 42%. I'm sure I could get to a price that makes sense, but I need to be conservative with my assumptions based on the fact that their balance sheet has so much debt on it. I don't think I've ever seen a company with more than $120 billion in debt, and so I just need to be fairly conservative there. And do I think that this dividend can hold? Yes, but I want the company to start buying down debt. And so I don't want them to increase this dividend. I wanted to keep it flat, or even if they were crazy serious about it, even cut it. Yeah, that hindered the stock, but you cut a dividend, the stock goes down so cheap you'd want to buy back shares even with some of that allocation. To then maybe you're paying 30, 40% of free cash flow to buy down, um, buy back shares, and then 70% to pay down debt. I mean, it's just the business is going to be tough. And I mean, to me, I'm just being conservative because their use of cash flow has always been interesting in the past. And so I don't know whether they'll do the right thing here. But I think right now I'm fine with these assumptions. I think that although the payout is less than 50%, their payout ratio on their dividend is less than 50%. They just have a lot of debt, and I'm concerned about it, and I want them to start really focusing on paying that down. So I hope everyone enjoyed the video and has a great rest of their day.